Hi, this is Mark from Success with Options. A calendar spread is an options trading vehicle that offers a number of advantages for the options trader. What I'll be doing in this short video is going over some of the basics of a calendar spread and then jumping right into an example showing how to set up the trade, calculate position size, and entering the trade. We'll also talk a bit about monitoring the trade and exiting. Calendar spreads are made up of two options held in different months. One option will be sold, the short strike, and one will be bought, that's the long strike. A calendar spread will either be two put options, making it a put calendar spread, or two call options, making it a call calendar spread. In my mind, there are several key advantages of the calendar spread. First and most important is the fact that it has limited risk. As we'll see in a minute, I know exactly what I'm risking on the trade before I ever enter the trade. Second, like vertical spreads, calendar spreads can benefit from time decay. That means that in many cases I don't need the stock to go anywhere to have my calendar spread be profitable, although having it move to the short strike can make the spread a more profitable trade. Because the short strike is usually sold in the current month and the long strike is bought further out in time, the short front month option will decay in value more quickly than the long farther out month option, which is how the spread makes money. Because the long strike is bought at a farther out month than the short strike, the long strike will cost more to purchase than what I can make from selling the short strike. Therefore, the spread will be put on for a debit. In the ideal scenario, I will realize my maximum profit when the short strike expires exactly at the money. This leaves my long strike with one or more months of time value. This brings up another interesting point about calendar spreads. Calendar spreads can be created from long and short options spanning multiple months. For example, I can buy a September option and sell a June option skipping July, rather than simply closing the trade out on or near expiration of the short strike. We'll roll the strike from June to July for a credit, reducing the overall cost basis of the initial trade. Let's actually look at an example to help illustrate the calendar spread. What we see here is a chart. At the moment, it doesn't really matter what the chart is, and we see that the chart is in a bullish trend. While not strictly a bullish strategy, I could put on a put calendar at $90, buying the July $90 put and selling the June $90 put. The result is that the spread will be put on for a debit of $1.30. What's the most we can make on this trade? With calendar spreads, it's difficult to determine exactly, but we can estimate. If the short June option expires with the price right at $90, the spread would be worth as much as $2.17, but we paid $1.30. So that would leave a potential profit of 87 cents. What's the maximum loss? If the stock took off and went to $1.20, or it went to, let's say, $70, we would likely experience a maximum loss on the trade, and that would be $1.30. I'm going to finish this video using a put calendar spread on the SPY. What I've covered so far is some pretty basic concepts on a calendar spread. What we'll see as I go through an actual trade is how we could evaluate a 1-month versus a 2-month spread, as well as how to use the analysis tools on the thinkorswim platform to estimate potential return from the trade. What we're looking at is a trading platform provided by thinkorswim, a leading options brokerage. One of the cool features of having a thinkorswim account is the ability to also have a virtual trading account where my experience is almost exactly the same as if I were trading a real account. So let's begin by taking a look at the chart of a stock, in this case an ETF that is in a bullish trend. SPY is an ETF representing the stocks that make up the S&P 500 index. You may recognize this chart as the one we were looking at earlier. So what we have here is we have a stock that has moved up, and as we talked about in the slides, we're expecting potentially a pullback down into the $90 range, maybe a little more, maybe a little bit less. We have outlined a position at $90 where we would create a $90 calendar by buying the June $90 put and selling the July or perhaps the September or the August $90 put. And so what we want to do now is take a look at some of the different options and do some analysis to determine what makes the most sense, and then we'll go ahead and move forward in setting up the trade and entering it. Okay, here we are back on the platform. What I'm going to do is switch over to the trade tab, and we've already got the SPY entered in. The standard layout in the thinkorswim platform allows us to see all of our option chains, and we see we have a June and a July and an August and so forth. What I want to do is I want to do a little bit of analysis to try and determine what is the potential profitability. As I mentioned earlier, It's a little more difficult to figure out what the profitability might be of a calendar trade simply because so much is determined by the values of volatility, the current price at the expiration, how many days till expiration, if we decide to close a trade early and things like that. So the best that we can do is take a couple of passes at doing some estimation to determine what the value of the spread might be. One of the things that we can do is let's just take a look at the initial trade and see if we can set up something that we talked about. So we were talking about a $90 put calendar spread. So what I can do is just set the order up initially and see what it's going to cost us to enter. Okay, so I go right mouse click over the front month, the $90 put, and then I want to buy a calendar. And by default, it's going to default to a single option chain spread. In this case, we have some June quarterlies that are there. We want to move from the June quarterlies to the July so we get an exact month to month. So here we have a 1 month $90 put spread, currently trading at $1.29, give or take a penny. So that's the cost of a 1 month spread. What we can do is take the long month and let's go out one more month to August, and now we have a 2 month spread. Now the way we can consider the cost of this position is to look at what is the average cost per month if we were to do it this way. Well, we have a mid price of about $2.52. Let's call it $2.50 for quick analysis. So what's the cost then of 1 month on a per month basis? It'd be about $1.25. So if we compare the 2 month spread, which is costing us $1.25 per month, with the 1 month spread, which is costing us $1.30, we can see that there's a slight increase in the amount of the cost of the calendar spread to get into it. So we're basically giving up 5 cents of potential profitability by taking a 1 month spread instead of a 2 month spread. Realizing, of course, that we have 2 opportunities to roll and close that position if we take a 2 month position. The other thing we have to consider, though, is that if we go back to the chart here, what is it we expect to have happen over the next couple of months? We have 2 options that we can consider when we think about putting on a 1 or a 2 month calendar spread. We can put the calendar spread on for 2 months and trade it over the entire 2 months, or we could put the calendar spread on for 2 months because it gives us a better entry price per month, but yet we could still close that trade early if we desired. So I'm a little bit concerned about holding a spread, a put calendar spread at $90 at this point, as long as this current trend continues. However, the other advantage that I see to having a 2 month spread is that we're looking at the potential of anything happening over the next couple of months, and it gives me a little more time with which to make money on this particular trade. So the point I guess I'm trying to make is that we need to kind of factor in all of those points of consideration as we're looking at the entry. So let's go back over to the platform. I'm going to switch back to the August calendar, and we're looking at about $2.50 of entry. Now, the hardest part about figuring this whole trade out is analyzing, again, the potential profitability. I'm going to show you a little trick on this platform. On my website, I use the OIC, the Options Industry Council tool that they have on their website, which is a pretty cool tool for doing analysis. I'm going to show you another way here that on the Thinkorswim platform we can do some quick and dirty calculations. What I want to do is I want to go, as we see here, we're looking at the spread type of view on the options chain. What I'm going to do is I'm going to switch to a calendar. Now what I want to do is I want to analyze the potential theoretical price of closing on the calendar from June to July, remembering that we had that June quarterly in there. So I'm going to, rather than just doing a calendar view, I'm going to switch down here to a deep and wide. We want to go 2 month, 1 strike calendar. What we see then is that we have right in front, we have our June-July calendar spreads right there, and then we can see that we have the $90 calendar, and it's currently trading at somewhere between $1.27 and $1.29. And let's see, if we reset everything, we have a theoretical price which is pretty much right dead in the center, $1.28. So we see the price is fluctuating a little bit, probably due to the move of the stock up and down. What we can do is we can ask ourselves the question, what if time was to move forward to the Monday before expiration and the price was to move down from the current price of 94 to around 90? So that would be about a $4.94 move down.